Hey guys, Tim here. Ever wondered why some property investors seem to do really, really well all the time while others struggle? The secret might be in their portfolio mix. So let's talk about why diversifying your property portfolio could be your ticket to long-term success. Why? Let's bring it back to the basics of why you should consider diversifying your property portfolio. So one, spreading geographical risk. Okay, this is a reason, and this is a general thing that a lot of people get wrong. Okay, different areas perform differently over time. So, sometimes a beach area would take off. Sometimes a city area will take off. Sometimes a new infill residential area will take off. Other times, light industrial goes crazy. So there's different points in the market, different points in the cycle for all different types of property. You know, for example, he used to have a client. He used to love mining towns. Someone had sold him on the fact that, oh, you're always going to make money in a mining town. It's going to go boom. It's going to go boom. It's going to go boom. You're always going to make money. But what happens when the mining town shuts? Now, we've seen this many times in Perth, in the Western Australian basins there. We've seen it in the Southeast Queensland basins. We've seen it in the Gladstone Basin. I had a client up there many years ago who bought a property up there at 250 because, he was told, oh, it's a mining town, it's going to go boom, it's going to go boom. And yes, it did go boom. Those properties went up to about 800,000. But that was great for 3 or 4 years, and then all of a sudden they shut the mine. Those properties went from 800,000 back to 300,000. So if you bought at the wrong time of the market, if you bought, three-quarters of the way up, or even when it peaked, you were then left with a property that was overvalued, over leveraged, that you couldn't do anything with. You couldn't sell without making a tremendous loss. So looking at these markets, looking at the way they move, and getting in at the right time is very, very important. Okay, so this is very important. Why, when you're buying multiple properties over time, we also look at complementary locations. So some areas are going to be great for slow long-term growth. Okay, and when I say slow, we're still talking 7-8% year on year. Other places will go boom overnight. They'll almost double in 3 or 4 years, but there's a risk that they could drop back. So, but the rent may not keep up with the mortgages as well. So we have to try and balance things out. We have to make sure that our cash income is keeping stead with our mortgages and with the properties that are growing around in our portfolio. To do that, we look at different property types. Okay, now there's three main types. You've got your residential, you've got your commercial, and you've got industrial. Okay, now to break that down a bit more for you, residential is obviously houses, apartments, places where people are actually going to live and sleep. Commercial are things like shops, little grocery stores, little lawnmower outlets, hairdressers, tattoo parlors, various bits and pieces. Okay, industrial is anything that's like a warehouse. So it may be for storage, it may be for manufacturing, it may be split between commercial and industrial because they have a little shop front in front, but it's still an industrial property because it is a warehouse. Okay, so each of these different types, they've got different income streams and they've got different growth patterns. Your residential as a general growth property because it's needed for housing, it's needed for people to live in, etc. Whereas your commercials and industrials tend to be a little bit more cash flow positive for you because the tenants will also pay the outgoings in these situations, which are things like the rates, the water, stuff like that can also, really kicks in. Water connection, not just water usage, which is what is done in residential. But they tend to grow a little bit slower, but they're also subject to slightly longer periods of being empty when they become untenanted. It does take a little bit longer to get a commercial or industrial tenant back into those type of properties. So while you're investing in those, that's great, but just make sure you've got a little bit up the back of your sleeve to cover for any times where the property may be untenanted. In my portfolio, we've got, my wife and I, that is, we have a combination of properties. We have a couple of apartments, we have a couple of townhouses, we also have a couple of houses, and also we've just taken on a commercial property as well. So we're spreading the risk. We also have them in different places. We don't have them all in one location. They're spread around the country, New South Wales, Queensland, and now Victoria. So it's amazing how these different properties in different areas at different times will balance each other out. When one area is growing and not quite doing so well, cash flow wise, you find other areas doing really well cash flow wise, but not growing quite as fast. And so they tend to balance each other out. So it gives you a really nice balanced portfolio, which is at the end of the day what you're looking. So everything grows and everything is putting itself together. Okay, so when we're talking about balancing, there's different strategies around that. There's a growth strategy and there's a yield strategy. So yield strategy is things like your rent, the return that you're getting from that. So if you're chasing cash flow, you definitely want a couple of properties in your portfolio that have a yield strategy. If you're looking for overall growth over time, you need to have a growth strategy. You need to have properties that are going to grow in value. There's no point in buying out the back of Burke, because it rents really well, but it never grows. So again, it's what works for you, and we will help you tailor this to your goals. Okay, so we've got to look at what your goals are as to which profile, which type of strategy will work the best for you. And generally, in combination is where you get the best results, because as I said, one part balances out the other, which then helps you get the loans you need to grow the portfolio, to get that next property, to get that next property. And it's all about leveraging and making sure that you've got cash flow to ensure that you can pay the mortgages. So with risk management, we do a lot of that in mixing up our property types, because what that helps us with is when there's possible market downturns. Not every area is 0.1% vacancy rate all the time. Sometimes they go a bit out of favor with people. People want a newer area, or they want to move a bit closer to somewhere else, or so sometimes that rental vacancy rate will go up, which makes them takes them a little bit longer to get rented out, which therefore means you can't hit people up as much for rent increases, that type of thing. So again, this is where diversification in different areas, because some areas are going to boom, some areas are going to wane off a little, and if you buy in the wrong area, totally go bust. But diversification is really what helps you out. When it comes to that, it really helps in the long term, because when things start going a bit pear-shaped, because you've diversified, it helps protect you. It makes life easier for you. You're not stuck with, all your eggs in one basket, shall we say. So spreading the risk out, spreading things out, is a much greater and wiser way of strategizing to ensure that your portfolio grows at the best rate it can, to do what you want it to do, to meet your goals and your financial targets in your personal life. So we want long-term growth. Long-term growth works well for us because that's what helps us to leverage. That's what helps us to buy the next property. So growth's important, but cash flow is just as important when it comes to making sure that these mortgages are paid, which therefore means that the bank, likes you and will continue to lend you more money. So if you're ready to take your property portfolio to the next level, let's chat. Let's discuss how your goals can be met and how we can diversify your portfolio to ensure that you get there faster.